rise, our hopes fade, leaving us wondering where we're going to get all the extra money. Well, mortgage lenders may now have the answer. They're prepared to let us borrow more, in fact, a lot more than in the past. But is this a generous gesture or a bit of a gamble? How much are you prepared to risk to buy a new home?
Well, this one's it's just come on the market this week.
Carla Chases has weighed up the risks, done her sums and is now looking for somewhere to buy. She's been saving for months for a deposit and is getting financial help from her parents. But she admits it's still far from easy, trying to afford a place she can call her own.
It's all a bit of a worry, really. I definitely think I probably borrowed a bit more money than I should have done. But I just think that for me there's no alternative, really. I do want to get onto the property ladder, and financially, I'm just going to have to prepare myself for things being very tight, unfortunately.
Traditionally, lenders have been very strict about the amount you can borrow for a mortgage, relating it to what you earn. But some are now relaxing the rules, even offering so-called no-proof mortgages, where in some cases you don't have to provide any evidence of your income. It's led to the suggestion that some lenders are making it too easy for people to get into debt.
I think lenders aren't lending irresponsibly. They still take a considerable amount of time in assessing customers. They may not do so through employers' references. There are moves towards simplifying and speeding up the process with self-certification mortgages, so customers say their income. Now that is verified by looking at credit reference agency database and checking how individuals have used credit in the past, their behaviour, and assess their income that they've stated against their likely income in their employment. So there are a number of checks lenders do behind the scenes.
Of course, having a big mortgage needn't necessarily be a worry, especially with the cost of borrowing relatively low. But what if interest rates rise? What then?
What you can do to protect yourself against interest rate rises is take a fixed rate, because it doesn't matter what happens to the economy. If rates rise, you know your rate is going to stay the same. But I would suggest only take a fixed rate for 2 or 3 years. The other thing you can do, if you're looking to take more money and you're a young professional, take an interest-only mortgage for a couple of years until your income increases. But you must make sure in a couple of years' time you then go repayment.
And obviously you've got the kitchen.
At the moment, many say Britain is in the middle of a mini housing boom, which doesn't help first-time buyers like Carla. And some say the irony is that had lenders not helped to boost the market by allowing people to borrow more, prices may well have fallen by now, which would have made Carla's life a whole lot easier. Karen Bauman, BBC News.
Now, the Trade and Industry Minister